Hey everyone, welcome back to our channel. If you're new here, I'm Your Name, and today we're diving into a topic that's super important for anyone considering investing in real estate: capital gains. Whether you're a first-time homebuyer or a seasoned investor, understanding capital gains can help you make more informed decisions. So, let's get started. Now, you might be wondering, what exactly are capital gains, and why should I care about them when it comes to real estate? Great question. Let's break it down. Capital gains refer to the profit you earn from selling an asset for more than you paid for it. In the context of real estate, it's the difference between the amount you sell your property for and the amount you originally bought it for. Sounds simple, right? But there's a bit more to it than that. Let's say you purchased a home for $300,000. Over the years, due to market conditions, renovations, or other factors, the property appreciates in value. When you decide to sell that home for $400,000, your capital gain would be $100,000, which is the difference between the selling price and your original purchase price. Now, it's important to note that capital gains can be classified into two types: short-term and long-term. If you sell your property within 1 year of buying it, any profit you make is considered a short-term capital gain. Short-term gains are typically taxed at your ordinary income tax rate, which can be significantly higher. On the other hand, if you hold the property for more than a year before selling, it qualifies as a long-term capital gain. This is where it gets interesting. Long-term capital gains are usually taxed at a lower rate, ranging from 0% to 20%, depending on your income level. This is a huge incentive for holding onto your investment for a longer period. Let's take a closer look at an example. Imagine you bought a condo for $250,000 and sold it 5 years later for $350,000. That's a $100,000 capital gain. If you're in a tax bracket that qualifies for a 15% long-term capital gains tax, you'd owe $15,000 in taxes on that gain. Not too shabby compared to what you'd pay if it were a short-term gain. However, there are some nuances to consider. For instance, if you lived in the home as your primary residence for at least 2 of the last 5 years before selling, you might qualify for the capital gains exclusion. This means that you can exclude up to $250,000 of capital gains from your taxable income if you're single, and up to $500,000 if you're married filing jointly. This could significantly reduce your tax liability. According to the IRS, around 2 million taxpayers claimed the capital gains exclusion in 2021. That's a significant number of people benefiting from this provision. So, if you're considering selling your primary residence, make sure to take this into account. Another thing to keep in mind is that not all improvements to your property can be deducted from your capital gains. The IRS allows you to deduct capital improvements. Those are enhancements that add value to your property or prolong its life. For instance, if you renovated your kitchen or added a new roof, those costs can be added to your property's basis, which reduces your capital gains when you sell. However, regular maintenance and repairs, like painting or fixing a leaky faucet, don't count as capital improvements, so keep that in mind when calculating your potential gains. Finally, remember that real estate markets can fluctuate. While you might purchase a property today and expect it to appreciate over time, there's always a risk involved. The market could decline, and you may end up with a loss instead of a gain. Always do your research and consult with real estate professionals or financial advisors if you're unsure. To sum it all up, capital gains in real estate refer to the profit you make from selling a property at a higher price than you bought it. Understanding the difference between short-term and long-term gains, as well as potential tax exclusions, can save you a significant amount of money. Always consider holding your property for the long term to take advantage of lower tax rates and possible exclusions. Thanks for watching today's video. If you found this information helpful, please give it a thumbs up and share it with anyone who might benefit. Don't forget to subscribe for more educational content on real estate and finance. And if you have any questions or topics you'd like us to cover in the future, drop them in the comments below. Until next time, happy investing!